3 after. Thank you guys so much for coming. I do see a couple familiar faces, so maybe you remember my face, I'm not sure. But we come out here about, I don't know, almost quarterly. Yeah, so thank you so much for bringing your lunch and actually taking some time to really think about your financial health. That's what we're here for. So my name is Kim Sullivan. I work for BMO Harris Bank. I've got a couple team members with me here, and I'll introduce them in just a second. Our program is called Bank at Work, and really the key to our program is bringing education to the workplace. So we try to, we realize that a lot of people don't have time to kind of sit back and pause for a moment and kind of think about their finances and the things they've got going on. There's always really good intentions, but sometimes we don't take the time to do it. So I do appreciate you taking the time today to do that. You're in for a really good treat. I don't think we've had Lynn here. I think Lynn, maybe you came a few years ago in the older building.
Location, yep.
It was about 3 years ago probably, or at least 4 years. I've been with BMO for going on 14 years. And Lynn has been doing this for a long time. She actually won't tell me how long she's been doing it because she doesn't want me to give away her age or anything like that. But you guys are in for a really great treat. She's very knowledgeable. The content today is very very informative, and you're going to walk away with some really good things and some action plans, I have a feeling. So I'm going to introduce Beth. Beth is actually here. You guys, if you've been to our classes before, Beth is my partner in crime. I don't know if we should say that as a bank. Beth works at our Roseville location. Her cards are in the back. If you have any questions at all, she's a great resource. Would be happy to help you if you have any questions in regards to anything that we've talked about today. And then I'm going to introduce you to Lynn. So Lynn is here today. She's going to talk about retirement income planning. You've got a lot of stuff in your packet today. The very top sheet, I'm going to ask you to do one thing for us, and that's to fill this out. You do not have to fill out the bottom if you don't want. What this form is really gives us an idea of what you want to have more content about. So if we come out here again, we really want to hear, like, what are some topics that you guys would like to hear about? So when you're thinking about filling out that form, just rate it 1 through 5. 1 would be the most important category. 5, not so much right now. And you may have filled one of these out before, and maybe your 1 through 5 changed. So this is a good exercise just to kind of figure out what's most important to you in your life right now. And if you want Beth to give you a call back, or you have any questions, feel free to fill out that bottom. Beth will collect these at the end of the presentation, and just so that's your only homework is to fill that out for me. Okay? All right, so I'm going to turn it over to Lynn, and you guys enjoy.
Great. Good afternoon. So you've got a copy of all the slides, so just saying, feel free to take some notes there. I've also included in your handout a tax reference guide for 2019. So throughout our discussion today, we're going to refer to that piece quite a bit. The focus of our conversation is really all going to be about retirement income planning. I'll tell you, several years ago, the financial planning industry as a whole realized that there's so many tools out there for employees to help you decide how much to put away in your 401k, what percentage of your income should be pre-tax in the 401k versus after tax. All these tools out there to help you be motivated and stay on track to accumulate for retirement. But very, very little education that actually helps you to say, okay, now once I've accumulated and I'm 5 to 10 or even 15 years from retirement, how do I begin to plan to take income from that? Let's see, I hope I didn't lose my screen there. So that's what we're going to talk about today. It's kind of like, you know, in essence, you're climbing the mountain, you're accumulating dollars in your 401k, in your Roth IRAs, in your regular savings accounts. Then you're getting ready to retire, and it's like, okay, now what? How do I turn that lump sum into income? What income sources do I need to be taking a look at? So with regard to retirement income planning, our primary objective is to help you identify some of those potential problem spots, the landmines on the way down, the things that you need to be kind of cognizant of even well before you're retiring, just so that you are aware of what your decision points need to be. And that's really kind of what we're here to talk about today. So as important as it is to put dollars away and to be aware of options for that, it's also important to keep in mind how you're actually going to turn that into income. We're going to talk really about 5 different areas. We're going to talk about some of the risk management affiliated with those 5 areas. before we get into that, we're going to talk about the questions that talking through these 5 areas should answer for you. Number 1, what will your retirement nest egg provide in terms of guaranteed income sources? What pension type of accounts do you have out there? What things do we know are going to come in like clockwork each and every month in the checking account just to keep the lights on in the house, just to keep the household moving as it should be? Then also, what type of retirement income, or I should say expenses, will you have that you don't have while you're working? How are you going to spend your retirement time? And is your retirement income going to be sustainable over your lifetime? The bottom one is probably really important to take a look at right now, and that is really considering the rise in inflation. We're coming out of a period of time here historically where inflation has not been a primary concern. The Great Recession, now as we call it, from kind of like October of 2007 through February of 2009, we had an artificial suppression, if you will, on interest rates as well as inflation. And since 2009, up until this year, inflation has been pretty benign. It has not caused problems. It stayed relatively low. 2019, however, we're seeing an increase in inflation. Any of you in the room have a friend or a family member or someone that you know on Social Security, taking a Social Security benefit, maybe a parent? This is the first time in, gosh, about 9 years where there was a significant increase in their Social Security benefit because it's linked to inflation. Linked to inflation is measured by the Consumer Price Index. So that's an important thing to keep in mind in terms of how long is this money going to last once I retire. Then we also want to be talking a little bit about the healthcare piece. I work all day long putting together financial plans for individuals who are in essence looking to retire. And whether a person has very modest means or very great means, there's one common denominator with regard to risk, and that is the unknown cost of healthcare. The cost of healthcare is going up, as you probably are well aware, it's your business, over 4 times the rate of regular inflation. So it's an important thing to take into consideration with regard to things. Now here's another element of retirement income planning that maybe doesn't seem quite as intuitive as some of these other areas, and that's the whole realm of your estate plan. The second question down, are you up to date with your wills and powers of attorney? In other words, as you're planning for retirement income, you want to be sure that the legal side of your estate is managed for as well. Here's the number 1 primary reason for that. Many times I'm working with retired couples who love to travel. Most of the time they travel together, sometimes they don't. In the event that one or the 2 of them actually are out of town or traveling and a financial decision needs to be made, maybe regarding their IRA or their 401k, the spouse cannot just step into their shoes, even though they may be beneficiary on the account, without a power of attorney document. So it's very important to be sure that that POA or power of attorney is in place at retirement, along with the other estate planning type of matters that you want to have ruling over your estate. So these are the types of questions that are answered by going through a retirement income plan. Decisions that need to be made generally fall into these categories. The first one, how long do you have to accumulate assets? This is the stage that you are probably in right now. You may be thinking to yourself, it's a Wednesday, so maybe not as bad as a Monday, but on Mondays usually people say, I want to retire at 55 or 59 and a half, as soon as I possibly can. Usually by the closer we get to the end of the week, that age wanes just a little bit. But how long you have to accumulate assets, whether you're 5 years away from thinking, gosh, that's the age I'd like to make work optional, or you're 15 years. You need to kind of keep your eye on that figure. Time is on your side. The younger you are, the bigger effect you can have on how much you set aside long term. How long will you need to take distributions? This speaks directly to longevity. Because of advances in healthcare, people are living longer than they ever have before. maybe not always as productively as they would like to, but longevity is a potential risk to your retirement income plan as well. The next big question, and this is something that all of you can start to look at right now, how much will you receive in Social Security? Have you all gone on to the Social Security website and looked at what your estimates are? Maybe so, maybe no. If you have not, you should jot this website down, ssa.gov, socialsecurityadministration.gov or ssa.gov. You can go on to that website and take a look at your earnings history and what your projected estimates will be. Now you have to log in, you have to prove that you are who you say you are, okay? And so if you've never been on there before, they're going to pull a series of 3 multiple choice questions from public record. You go on to the site, you enter your information, your quiz, as I call it, will pop up. If you answer your multiple choice questions correctly based upon public records, like have you ever owned a 2010 Toyota or things along those lines. If you answer those questions directly, correctly, you'll be able to get into the site and you should look at your earnings history. Once in a while, we find clients who have an error in their earnings history, and it's usually a massive error, like a digit was dropped. So rather than a $40,000 a year income for 2017, it was $4,000. So the Social Security Administration will make corrections, but they'll only go back 3 years. So the takeaway from that is every 36 months, you should go in and just review your Social Security records. The benefit behind going in there really is twofold. Number one, to be sure that their information is accurate, and they no longer generally mail those forms out, so you need to look at it online. But it also is going to give you an idea as to what your projected benefit will be. Now, inevitably, when I talk about projected benefits, what goes through people's mind is, well, they may say I'm going to get this much, but is it going to be there, right? And this is generally what I tell my clients. If you are 50 or older, it is very likely you're going to get what the estimate is. If you are 60 or older, you can count on it. You'll probably get that benefit that they're estimating for you. If you're under 50, it's up to you whether or not you want to include that estimate in your retirement income plan, because it's very likely the form and the dollar amount is going to change between now and the time that you're actually full retirement age. We're going to dive into a little deeper as to what full retirement age means in Social Security speak in a moment. Fifth thing, we have to take a look at health insurance. So as I mentioned earlier, many times people are thinking, gosh, I want to make work optional as soon as I possibly can. If possible, I'd love to retire at 60 or 62. The health insurance piece really comes into play from the standpoint of Medicare doesn't start until 65. So how then are we going to bridge that gap, potentially a pretty sizable out-of-pocket expense gap to get you to Social Security or to Medicare age? And then finally, the impact of pension benefits. If you have a 401k, that's a defined contribution plan. If you have a traditional type of pension, that is a defined benefit plan. Both of those plans, sponsored by employers and generally funded by a combination of employee contributions and employer contributions, will have different types of distribution rules. That's why we have that as a separate item on the piece. So just kind of as a recap, here is the 5 key risks in retirement. And we're going to talk a little bit more in detail about some of them as we go forward. But it's the healthcare risk. What is that cost going to be? And can your dollar amount that you've saved for retirement sustain a healthcare cost, as I call it, earthquake, okay? Market risk, market volatility. This isn't something we're going to talk too much about. That really applies more to the accumulation stage, but it is a risk nevertheless. Withdrawal rate risk. Here's where we talk about the sustainability of how much you're taking out of what you've accumulated versus how long you're going to live. Inflation risk and longevity risk. Inflation risk we're going to delve into quite deeply as well. Any questions so far? So let's talk about how long retirement will actually last. As I mentioned, people are living longer than they ever have before. Typically, a 65-year-old can plan on a life expectancy of 18.7 years. That is significantly longer than even 10 years ago when we looked at this. It's not inconceivable that you will need to have set aside enough money to last you for 25 years in retirement. So if you're counting on just a Social Security payment, you know, that may last for a while, but if you have one of those economic earthquakes, as I mentioned, like an unusually high health care bill, that can rock your world, right? So we've got to plan for the longevity risk. I'll tell you, now the statistics are saying for a couple age 65 or older, in fair health, not necessarily great, but in fair health, there is a 70% chance that at least one of them is going to live to age 90. So definitely we've got to be keeping in mind longevity risk. So the longer you live, year after year, if we've got inflation going on, we've got more inflation risk, right? How far does your spendable income go? I mean, if you've got $30,000 a year of basic expenses on an annual basis today, what is it going to require in the future to still cover those same basic expenses? This is a really good way to look at that from a graph standpoint. If we're looking at just basic retirement expenses, and we've got a inflation factor of about 3%, we can see basic expenses in 2016 of roughly $36,000. By the time we reach the year 2036, so just 20 years later, right, it's going to take $43,000 to go the distance that $36,000 does today. Healthcare costs, I mentioned 3 or 4 times the rate of regular inflation. So in 2016, average healthcare expense cost out of pocket, including your deductibles, your co-pays, cost of prescription meds out of pocket, things along those lines, $12,000. 20 years later, at a higher inflation factor, 3 times the regular inflation rate, nearly $60,000 a year. Yes?
This may be a silly question. How, the basic expenses from 2016 to 2026 to 2036, how do they go down in 2036?
So they're going down in 2036 as a result of the fact that we're assuming that someone passes away.
Okay.
A great question. So this is for a couple.
Okay.
So the idea there is that, okay, if expenses are level, if one of the couple passes away, then generally you're going to have half the healthcare cost, even though your basic living expenses may stay the same. Great question. Thank you for bringing it up. Everyone was probably thinking. Great. Any other questions? All right. As I mentioned, Medicare kicks in at 65. Now for some individuals, if you're still working at 65 and covered by an employer-sponsored health plan, you can get a waiver that says, hey, I'm not signing up for Medicare yet, but I do have qualified insurance. If you exceed age 65 without signing up for Medicare and don't have a waiver, you have a penalty, and that penalty is imposed on your Medicare premium each and every year going forward for as long as you live. So everyone in this room is way too young to be thinking about that, but your parents or other relatives may not be, so that is something that you should keep in mind. Medicare prescription drug coverage is now a standard under the healthcare changes. There are Medigap policies that can be purchased as well. So in some situations where we've got an individual who is looking at retiring at 62, as an example, we've got 3 years to bridge that gap there. There are policies that you can buy in the retail market to just bridge that gap for a couple of years and get you to full Medicare age. One thing we like to state is for Medicare, there is no provision for traditional types of nursing home or home health care. So here we're talking just about your standard health care costs, nothing really to do with the long-term care event. There are some situations in which Medicare will cover transitional care and things along those lines, but it definitely has to fall under that definition of a transitional care type situation. So here's an example I sometimes use. For an elderly individual, one of their largest risks that lead to a long-term care event is a fall, right? They fall down. So maybe you've got an elderly woman who falls in her home, she breaks her hip. Someone calls 911, they bring her to the hospital, they do hip surgery, reconstruct her hip, they send her to a transitional care unit, generally after a 3-day hospital stay, and the purpose of that transitional care unit in the long-term care facility is to bring about physical therapy to rehabilitate her. And as long as she's improving and able to go home, generally within around 21 days, they're gonna say, okay, Medicare will cover this as a medical expense. But if during that time it comes to light that, gosh, maybe she should no longer be living alone, maybe we're not gonna get full mobility back, maybe there are some other long-term issues or issues with activities of daily living that will preclude her from going back to her home, and she is in transitional care for a while but stops improving and then goes into an assisted living type facility or something along those lines, that would not be a Medicare covered event. That would need to be either private pay or paid by a long-term care insurance type of account. So when we talk about healthcare considerations in this context, it's only the medical piece. The long-term care is certainly a different type of matter to discuss. Particularly in this day and age, there's about a 40% chance that at some point in your lifetime, particularly for a married couple, that someone's going to have an issue with an activities of daily living and need some form of extended help, either at home or in some sort of a facility. So managing to the cost of those is something that we try to take into consideration with regard to the planning process as well. Annual costs, these are national averages. I think in the Twin Cities, we can be slightly over the national average, roughly $78,000 a year annually, and that's for a semi-private room. So these are certainly things that we want to take into consideration. As I mentioned earlier, regardless of whether a client has great or very modest means, this right here is probably the #1 risk. You can insure it. You can transfer the risk to an insurance company by buying insurance. You can self-insure by putting aside a portion of your assets just for that type of process. Most people do some form of a combination. I mean, you don't want to be insurance poor, right? But it's a good idea to have a contingency plan in your mind with regard to where those costs would come from, which asset base would they be coming from. All right. And we're not advancing. Oh, here we go. Okay. Let's talk a little bit about the impact of taxes. You've got a handout actually in front of you, a couple of handouts, and the tax reference guide for 2019 is one of the pieces I use most often in kind of talking about some of these things we want to keep in mind. So it's all about keeping what you earn, right? So managing to taxation is a big part of identifying also how you should set up your retirement income. So we want to make a distinction between ordinary income tax, things that are taxed just like an ordinary income. So this would be your distributions from a 401k, this would be distributions from a pension, this even includes distributions from Social Security. On the left-hand side of the front page of your tax reference guide, you'll see the tax brackets for 2019. So you identify married filing a joint return, single, or the other options there. And what we're talking about in terms of the tax brackets is your taxable income. So we'll just use married filing jointly as an example, and let's say the income combined is $130,000. So it's gonna fall between that 78 and 168. Your marginal tax bracket then on the federal return is 22%. So $130,000 of taxable income for a married couple, your highest tax bracket or marginal amount is at 22%. What we have is a progressive tax system, however, so it doesn't mean that all of the money is taxed at 22. It means that any dollar amount over the 78,000 is taxed at 22. Now, we've had massive changes under federal tax law change to deductions, specifically standard deductions. So that is discussed in the middle column there. So married filing a joint return, you'll notice your standard deduction for 2019 is $24,400. So that $24,400 is subtracted from the income first and then applied to the tax bracket. Here's why this is important. You have a 401k or some sort of pre-tax savings system here, right? So if you identify kind of where you fall in your tax bracket, if a 1 or 2% increase in your contributions on a pre-tax basis allows you to go down in your marginal tax bracket, by all means, take advantage of that. By all means, now is the time. It's a great time of year to do a little bit of proactive tax planning for 2019 by estimating gross, how much you're going to take out in 401k on a pre-tax, still then applying your standard deduction or the itemized if you're still able to itemize. However, very few of us are still able to itemize. This is important because it will help you to discern how can I maximize my net income today and still save long-term for tomorrow, for retirement. Then at retirement, dollars that you then take out of your 401k are taxed as ordinary income as well. A couple things are not taxed as ordinary income, and that would be long-term capital gains, tax qualifying dividends, and tax advantaged accounts. Here's what that means. I'll start with the last one. HSAs. Do you have an HSA account here? Tax exempt. Maximize your HSA. You're going to benefit from it today as well as potentially at retirement. Here's a little key. It's not necessarily in your handout, but I would jot this down. If at all possible, you maximize contributions into the HSA and you leave them there. I know it's not always feasible to do that, but if you can absorb your out-of-pocket expenses from your cash flow, that would be beneficial. Why? Because it's a tax-advantaged account that's going to grow tax-free and can be used at any point in the future tax-free to offset your expenses. So because it's going to grow for you tax-free, we want to maximize our growth time, right? We want to keep it cultivating for growth as long as we comfortably can. Now I realize it's not always feasible, but it's an important concept to consider as you're looking at cash flow. Qualified dividends. Here's what we mean by that. If you own a stock portfolio outside of an IRA, outside of a Roth, outside of your 401k plan, and it pays dividends, usually if it's a US company, not 100% of that dividend as it's paid to you is taxable. Usually it's taxed at a lower percentage. And of course your tax reference guide gives you the information. So if you look, married filing joint, just under that in the gray area it says capital gains and qualified dividends. You'll notice that for certain income levels, or for the different income levels I should say, the rate of taxation is lower on tax qualified dividends than it is on ordinary income. So when we are preparing things for distribution and we're keeping in mind what our tax situation is, that is always top of mind, or it should be, of a good financial advisor. How can we get good diversification in a stock portfolio that pays dividends and minimize taxes? That's one of the ways that we do it. Long-term capital gain, the definition of that basically means you're buying an investment, a piece of property, something at a given value. If you hold on to it for at least 1 year, when you sell it, you're going to pay long-term capital gains on what it has appreciated to. Long-term capital gains are still a tax preferenced item. So again, we keep that in mind when we're lining things up in good order for retirement income. All right. Any questions on taxes? It's one of my favorite subjects. And that's only because I drink a lot of coffee. Otherwise it puts you all to sleep. All right. Now, sources of retirement income. This is kind of transitioning into the next area of discussion. We're going to look at Social Security, pension plans, 401ks, things along those lines, and then personal savings and investments. Digging first into Social Security. So at some point in time this week, you're all going to go onto the website. You're going to check out your earnings, and you're gonna get a feel for what your estimated benefit is going to be at your full retirement age. Full retirement age right now is a relative thing. The relativity of full retirement age is based upon your date of birth. So if you were born in 1960 or later, your full retirement age as it stands today is 67. Meaning that you don't have to wait until 67 to retire, but you have to wait until 67 to get 100% of your monthly Social Security benefit. So as an example, if you were born in 57, your full retirement age is 66 and 6 months. So there is a graded scale going on here. The purpose behind this was several years ago, Congress realized, we have a sustainability problem in our Social Security Administration process. Let's extend out the year or the age in which an individual can receive their full Social Security benefit. So they entered into this graded system. So again, if somebody is 50 or older, likely it's going to be 67 for you. If you're not age 50 yet, I would plan on this changing at some point in time. Just saying. Okay. All right. So, if we've identified when our full retirement age is, let's just say it's age 67. Our full retirement age is 67, so that's the year in which, or the age in which we get 100% of our benefit. But if we retire at 62, we have a choice. We could still draw Social Security at age 62, but we're only going to get 70% of our benefit. That's 70% of the benefit for your lifetime, so you have a 30% reduction there. If you wait until 65, you see it goes up to 86.7. This speaks directly to the longevity piece, right? If you knew how long you were going to live, you would know exactly when to draw Social Security. I would say this, if you've got good longevity in your family and you're healthy, plan on waiting as long as you possibly can before you draw your Social Security benefit, because that way you'll squeeze more of your benefit out of the plan. If you don't, then by all means consider drawing earlier. It's not uncommon for people to retire at 62, but then not draw their benefit until 64, 66, or even later than that. If you draw later than your full retirement age, then you get a premium. In other words, you get a higher dollar amount. You can delay all the way up to age 70. For an individual who does decide to delay taking Social Security until age 70, they get an 8% increase in their benefit for each year that they delay after their full retirement age. So people with true longevity on their side really benefit from doing things like that, from waiting. Any additional questions on Social Security? Did you all realize that your Social Security retirement income benefit is subject to income tax? Some people knew that, a lot of people don't. On the flip side of your your tax reference guide, if you look on the left-hand side, you'll notice right below where it says maximum earnings during the work years, then below that it says income in retirement causing Social Security benefits to be taxable. This is basically saying, as an example, for a married couple, if their modified adjusted gross income is $44,000 or more, modified adjusted gross income is your gross less 401k contributions, but before standard deduction, okay? So taxable income before standard deduction, then 85% of your benefit is taxable. So it's fair to say that unless you have an extremely modest lifestyle, most of us in this room are going to have 85% of our Social Security benefits subject to taxation. So when you keep that in mind, that's why we want to eliminate taxes as much as we can on things that we do have control over, such as the HSA, Roth IRAs, things along those lines. All right, employer pension plan basics. So employer pension plans, as I mentioned, come in a variety of different types of formats. And generally speaking, the two common areas or the two types are the defined benefit and the defined contributions. 401ks fall under a defined contribution plan. With defined contribution plans, there are a couple of rules that you kind of want to keep in mind. Number one, the IRS says this: if you are at least age 55 at the time that you separate from service from the organization offering you that 401k plan, you can begin to take distributions from that 401k plan even though you are not yet age 59 and a half. That is not something that's written down in your material, but that is an element of the tax code that has been around for quite a while, and it's an important thing to keep in mind. So here's the practical application of that. A person may decide to retire maybe at 57, not planning on Social Security until at least age 62. So you've got a couple of year bridge that you're gonna need to cover there. Distributions from the 401k will be allowable without a tax penalty. It will still be subject to ordinary income tax, but not to an early out penalty. So at least age 55, separated from service from the organization that provided you with that plan. Practical application of that is this: throughout your career, it's a very good idea to be rolling your 401k plans into your new plan if you've changed firms over time. Keep that pot of money healthy and growing as you're going forward. And if you are in a situation where you are able to retire early, or just doing a job change at 55 or older, you've got an element of flexibility with that money there then that you do not have with other IRAs, such as if you've been rolling over your 401ks into IRAs as you've been job changing. So it's a good element to keep in mind. Oftentimes, with regard to defined contribution plans, you also are able to annuitize your lump sum. So if you've got a plan provider that gives you an idea through maybe a series of tools online how much you should be putting away, and then if you've accumulated X amount over a certain of years, it will tell you about how much you're going to have in monthly income. Usually that is based upon a single life annuity. So looking at the average life expectancy of a 67-year-old and saying, okay, generally it's going to be able to pay out X amount of dollars on a monthly basis to assure that there's a guaranteed amount for you there each and every month while you're alive. That's a lifetime income option based upon one life. If you want to guarantee an income for you and your spouse, it's generally going to guarantee a lower dollar amount, and that would be a qualified joint and survivor annuity. We're not talking about an annuity that you would buy from an insurance company necessarily. The annuity concept here is just the method of calculation. A qualified joint and survivor annuity basically says, okay, husband and wife, as long as at least one of them is around each and every month to endorse the back of the check, we're going to guarantee that that dollar amount comes into their account each and every month for as long as at least one of them is alive. When you have that kind of guaranteed benefit, when the benefit is guaranteed over 2 lifetimes, then generally the dollar amount is going to be lower than it would be over a single life annuity. So the practical application of that information is, if there is a large age difference between you and your spouse, you may want to consider other ways to bridge that gap, where the reduction may be pretty significant. Life insurance is a way to do that, maybe repurposing life insurance that you bought when your kids were young, keeping it on the books, and then kind of using it as a survivor income annuity if someone predeceases the other for retirement. That works well then as well. Most often, inflation adjustments to pensions are not something that are guaranteed or written into the plan. Unlike Social Security. Social Security under its current format is mandated to increase with the Consumer Price Index, which is just one measurement of inflation. Pension plans generally are not. Based upon how well the pension plan is performing financially, they may give you a cost of living raise, but they're not obligated to. So reading the plan benefit explanation accumulation book well ahead of retirement is an important thing to take into consideration. So if we look at Social Security, if we look at anything that you would have through an employer-sponsored plan, we want to add those together, project them forward, and see what that would allow in terms of income, and identify whether or not we have an income gap at retirement. If we do have a gap, we've got to look to personal savings and other types of investments to bridge that gap. So here's where we get kind of into issues with respect to portfolio diversification. I could talk for a whole hour just on this, but I promise you I won't. You should have in your portfolio, however, a mix of stock and bonds to hedge against inflation, certificates of deposit that offer you some guarantees, Treasury inflated protection securities, or TIPS. These are becoming very popular right now. It's basically a bond issued by the federal government that promises to adjust the interest rate that you earn on that bond along with inflation. So it's a great thing to add to a portfolio right now. And distribution of funds. So keeping in mind what distributes on a regular basis, like a stock type of bond, stock dividend, or things along those lines. So when I work with clients, we spend a lot of time talking about how much do we need to have in just your regular savings account. 3 to 6 months living expenses is generally what we set aside. Are we maximizing 401ks through work, taking full advantage of any match that might be out there? And then over and above that, is there additional discretionary income that can be divided between maybe multiple goals? The two most common multiple goals are, and in this order, reducing debt and saving more for retirement. So if a client has maybe $200 to $300 a month extra that they want to put toward goals, it's $300, $150 is going to go extra toward reducing debt, the other $150 into a non-IRA investment account that is well diversified. Non-IRA, because that tax slide that we looked at, we want to take advantage of the tax preferential treatment of long-term capital gain, of the dividend payout being taxed at a lower amount, and give ourselves some more tax diversification at retirement as we're taking dollars out. All right, personal savings. You know, annuities in the most pure sense of the word are in essence a contract between you and an insurance company. We're not talking about annuitized pensions, that's a different thing. But annuities can be purchased as individuals. It is an insurance contract. It's not insuring you in case you die. It's insuring you against living too long. Annuities are designed for you to put money in a contract in exchange for some growth on that contract and an income guarantee down the road. If it's ever presented to you in a manner different than that, then something may not be quite right with how it's being presented. They have their place, but in some respects they maybe have been oversold a little bit. They have their place in a situation where we've got additional funds set aside, and the sole purpose of those funds truly needs to be to guarantee that we don't outlive our money. That is a great way to do it. So with annuities, in essence, you pay in a premium. An insurance company takes on the risk of you living too long, promises to pay you X amount a month or a year for as long as you live. Sometimes there's a lot of flexibility with regard to if you pass away sooner than what anyone thought, that the lump sum could be paid to a beneficiary. Sometimes there is not that kind of provision, however. So we want to be certain that all parties involved are aware of the risks affiliated on that. Much, much less flexibility once you get into an annuity. They're hard to get out of, but again, they do have their place. And on occasion, we at BMO Harris do make recommendations to clients for annuities. We do not underwrite them, but we do have a short list of companies that we've done our due diligence on and feel good about the contracts that they provide. So it can be a good tool to bridge that gap, particularly if there's not a lot of extra savings or margin in your account. Okay, not right for everyone, that's for sure. Okay, now let's talk a little bit about withdrawal rate. As I mentioned before, many times there's been kind of a rule of thumb with regard to the fact that a sustainable rate of withdrawal off of a lump sum like a 401k is generally between 3 and 4%. So if you've got a balanced portfolio and you're taking 4%, generally over an extended period of time, you should still have a slight growth in your lump sum balance. In other words, your rate of distribution should not cause the account balance to go down over an extended period of time. Some of the methodology regarding that has changed because market volatility today is much different than what it looked like prior to 2007. Things in the economic marketplace are kind of in a new normal, to kind of rephrase that terminology that was used. So when we look at withdrawal rates, we tend to use a bucket approach, dividing lump sums of monies maybe into 3 buckets, right? The first bucket is our first go-to bucket, and it has a planned obsolescence date. Maybe we plan on it being used for 3 to 5 years. And at the end of that 3 to 5 year period of time, we assume that bucket is going to be empty. In that particular bucket, we will use very, very conservative investments, things that don't fluctuate. So if we've got weird things happening in the stock market, we don't have to worry about it because our distributions are coming out of bucket number 1. Bucket 2 then doesn't have to be touched until bucket 1 is entirely depleted, right? So we can be a little bit more risky with that. When bucket 1 is done, then we turn the income on bucket 2. And the same holds true in the concept with bucket 3. The idea behind that is we're managing to current versus future income needs. So we can adjust the rate of distribution based upon how long we're going to need that rate of distribution. As an example, early in the retirement process, maybe you still have a mortgage payment to make for 3 to 5 years. But in 5 years, that mortgage is going to be paid off, and woohoo, you're going to stay in the house, so your cost of expenses are going to go down, right? So bucket 2, once that comes into play then, doesn't need to supply as much income as bucket 1. That's what we mean by future versus current income needs. When you utilize that concept of the pools of money, the different pools of money with different time horizons, you have a much greater possibility of having a sustainable distribution rate because each bucket can be invested for a different rate of distribution. If you are going much over 5% in rate of distribution, even if you've had a great year in your portfolio and you got 7 or 8, I'm just saying that's not going to work for you probably long term. Historical averages would say that rate of distribution needs to be a maximum of 4 or less in order for you to make that full 25 years in retirement or 35 years in retirement goal. So just something to kind of keep in mind there. And your online tools for your 401k generally tell you what their distribution rate assumption is, and it's usually going to be in the 3.5 to 4% range. So diversification of the portfolio is important. The difference between stocks and bonds. We do a lot of work at BMO Harris helping our customers and our financial planning clients come up with the right mix. But diversification doesn't just apply to whether you're buying stocks, bonds, or mutual funds. It also applies to your tax diversification. This is kind of a great cheat sheet because it gives you all of the options on one page. So tax deferred are basically those accounts that you are deferring the taxes on to some point in the future. The benefit of tax deferral comes into play when indeed you will be in a lower tax bracket in the future. None of us really know for sure, however. And I would maintain for your consideration that the younger you are, the likelihood of tax deferral working in your advantage over the long haul is minimized. And that is because tax brackets have had a way of going up, right? So if you are in your highest income earning years now, and when you're looking at retirement, you're going through this process, you're identifying all your income sources, and you say, hey, at retirement, it looks like I should be in a lower tax bracket. Great. take advantage of tax deferral. But if you're early on in your career, looking at tax exempt types of items might actually serve you better. Gives you no tax benefit today, but your tax benefit is in the future. When you take dollars out in the future, if you're in the same or higher tax bracket, it's benefited because there's no tax on the distributions. If you have an option in your 401k to do some pre-tax and some after-tax under the designated Roth element, then most of us should probably be doing a bit of both. Taxable accounts, taxing as you go, that gets into the long-term capital gain piece and things along those lines. So those three different types of accounts need to be a part of everyone's portfolio because it helps you to keep more of what you earn. Minimum required distributions, we talked a little bit about early out options and 55 being as a part of the 401k. In 401ks as well as in IRAs, there are some maximum age deferrals as well, basically being age 70 and a half. So basically stating if you're deferring taxes for too long of a period of time, the IRS says this, okay, you're now 70 and a half, now's our time to collect some of your taxes, so they're gonna require that you take a certain amount out, whether you want it or not, you have to take it out, pay taxes on it in order to comply with the IRS rules. And those really come into play for traditional IRAs, 403Bs, 401Ks. Not for Roth accounts though. No required minimum distribution for Roth, so we're in good shape there. All right, putting it all together. I'll tell you this, anybody who sits through an hour of me talking about this kind of stuff has earned the right to give me a call anytime and ask questions that may be pertinent to your particular situation. You've got my business card in your handout there. My main office is in Maple Grove, but I meet with a lot of my clients in Roseville as well, which is just down the road from you here. If what you've heard here today is of interest to you from the context of you kind of want to apply your personal situation to some of these ideas, some of these concepts we talked about, feel free to give me a call and we can do one of two things. We can talk about your situation briefly over the phone. I'll give you some ideas and some insights. Or we can arrange a time to get together and go through a kind of an abbreviated retirement income plan. There's no cost and there's certainly no obligation as a result of your employer's arrangement through our Bank at Work program at BMO Harris. So take advantage of that either in the short term or it's always an open offer. So keep that in mind. That really helps to put it all together because again, this information can be complex and complicated, but once it's applied to your actual circumstances, most people find that it becomes much, much more clear and a little bit easier to handle. So a lot of people have found that the discussion really helps to clarify what their retirement strategy is going to be and what their retirement vision is, and certainly we're here to help you develop an overall plan and then to keep you on course for that plan over time. All right. Coming up on our time here, but I wanted to open it up for any questions or other comments that individuals have. Yes?
Question.
Yes.
I work more than one job,
Okay.
so I've been told that any other job besides